Good to speak to you both. Lizanne, I'll start off with you because I really like the charts that you sent. I'm a chart kind of gal. And two of the charts showed sectors and the percentage of the stocks within that sector above the 200-day moving average and then the 50-day moving average. And just to put it in a nutshell, not too many were above the 200-day moving average. It's mostly defensive areas. And then above the 50-day moving average, which indicates momentum, many were going into the majority in terms of percentages. What does this signal to you?
Well, there's no question that breadth broadly has been much healthier in this rally than the couple of rallies since the bear market began in early January. That said, there's also been a bias in terms of strength, as you pointed out, in areas like utilities and consumer staples. So that's the antithesis of what you would typically see rallying if it was on the basis of a pickup in economic growth. And then you also have the fact that there's been a low quality bias to a lot of what has been working. You know, retail favorites index, which includes the meme stocks, non-profitable areas, high volatility stocks, low ROE stocks. And our message has been take advantage of this being a healthier breadth rally, but to use trader lingo, kind of fade the low quality stuff that's been doing really well and lean back into higher quality segments of the market.
So be wary of the stocks that have, because, you know, it's a big club of stocks that are more than 30% up from their June lows, Lizanne. But in terms of the ones that are, quote unquote, lower quality, get rid of those. But don't be afraid of those that have rallied more than 30% from lows, like an Apple, for instance, or mega cap tech.
If they've got the fundamentals, I also think we can't look even at the sector level monolithically. I think this is a factor-driven environment, and I think you still want to emphasize, call it a quality-oriented basket of factors like positive earnings revisions, better profitability, strong free cash flow, healthy balance sheet with high cash, low debt. I think that's a better way to approach the market in this kind of environment than trying to make a sector call or two.
Chris, turning to treasuries, you think that the 10-year represents a market risk, actually, as it potentially rises with a less hawkish Fed. It's gained slightly, but still below 3%. Yield curve is still inverted. What do you think are some of the catalysts there? And is it kind of portfolio rebalancing that could provide some headwinds for the equity markets?
So there's a few things there. One thing I would say is that our trading range, or the top end of our trading range, is 42 to 4,300. We're there. The risk reward in near term looks lackluster. We think things are okay, but we're not excited as we were a couple weeks ago. Getting back to the question about rates, you're seeing part of that today. What we've been saying is the cyclical part of the market, the value part of the market has really sold off, has really been beaten down. And we could see a bounce in that cyclicality as rates begin to increase. And the reason why rates could increase is the Fed it's not pivoting, but it's decelerating, right? And so people will believe that the economy is coming back in. You heard the comments from Walmart. Things are okay. They're not terrible. They're not great. They're okay. And that could let the door back open for some of these cyclicals. The problem with the broader equity market is it's a growth market. And if rates go higher, one of the reasons why we were positive on growth is lower rates. That could cause some choppiness in the near term.